Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This is where you get everything you need to know in 90 seconds at 9 o'clock. With news an expected cut in the RBA rate today will push their policy rate below its inflation rate. But first, factory data is weak worldwide. May factory PMIs are out, and for the US, they record a slowdown. Not overly severe, but a slowing all the same. The market version dropped to its lowest reading since September 2009 and signalled a factory stall, while the ISM version, one that is more closely watched there, also fell, but still recorded a modest expansion. Tariff-induced rising prices were noted as a concern by factory managers. US construction spending for April is showing flat no-growth data from March, but is 1.2% lower from April 2018. In something of a surprise, the private sector Chinese PMI, one that focuses on the level of company below their SOEs, came in marginally better in May than April. It was a small improvement in overall operating conditions, but is still an expansion, something the official SOE-dominated PMI doesn't show. Total new work rose at a faster pace, supported by a renewed increase in export orders. And China is setting up a blacklist of companies and individuals it will sanction if they offend China's stances on trade. It would hold special dangers for companies who trade with both China and the United States. Japan's PMI is stalled, but it's not all negative there, however. Japanese corporate capital spending jumped, growing at a very healthy rate of almost 7% when a contraction was expected. And this is on top of a more than 5% rise in April. And car sales in Japan were up 5% in May. EU PMIs, however, are contracting. Australian job ads posted their biggest monthly fall in more than 9 years in May, and a drop of almost 15% from the same month in 2018. However, a rise since their election was seen as suggesting some potential for a recovery. In Australia, auction clearance rates rose to over 60% last week, and the housing markets seem to be turning up as buyers return in numbers. Their winter slowdown looks like it's going to be postponed. Aussie home loan activity is picking up in tandem. And tomorrow, the Reserve Bank of Australia will conduct its regular monthly benchmark interest rate review, and it's widely expected to cut from 1.5% to 1.25%. But a growing chorus of private sector voices are expressing reservations about the wisdom of a cut at this time. And don't forget, inflation is running at 1.3% in Australia, so a cut by the RBA will drop the real policy rate into negative territory. US Treasury 10-year yield has taken another substantial fall and is now just under 2.07%. Bond market fear is spreading. And gold is up another $20 and is now at $1,225 an ounce. And the US oil prices are still down and now under $53 a barrel. The Brent benchmark is now under $61 a barrel. And the Kiwi dollar opens this week much firmer as it starts to gain a reputation of something of a safe haven. It is now at 66 US cents, which is a rise of more than half a cent overnight. On the cross rates were firmer too at 94.5 Aussie cents, and against the euro we're at 58.6 euro cents. That lifts the TWI to 70.7. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.